ICAI students, let's revise CA Final AFM Advanced Capital Budgeting Decisions. Practical question 22. A&Co is contemplating whether to replace an existing machine or to spend money on overhauling it. Overhauling is nothing but repairing. A&Co currently pays no taxes. The replacement machine costs 90,000 now and requires maintenance of 10,000 at the end of every year for 8 years. So replacement machine cost is given, and maintenance of that machine for 10 years is also given. A&Co currently pays no tax. This signifies that when we sell in case if we sell the existing machinery, there won't be any tax savings because of that loss in sale, or tax payable in case of profit. At the end of 8 years, it would have a salvage value of 20,000 and it would be sold. So the new machinery salvage value is 20,000 and will be sold at the end of 8 years. The existing machine requires increasing amounts of maintenance each year, and its salvage value falls each year as follows. So the existing machinery's maintenance cost and salvage values are given. So we have to see at which year it is better to replace the machinery. The opportunity cost of capital is 15%. So the requirement is when should the company replace the machinery. They are not asking whether they should replace or not. They are asking when should it replace. So we have to calculate the NPV for each and every year, like at the end of year 1, year 2, year 3 and year 4, and then we have to find equivalent annual cost by dividing the NPV by the annuity factor to arrive at a equivalent annual cost EAC. Then we have to compare whether the EAC is minimal at which year. So the year in which it is minimal, that year we should replace the machinery. Okay, going to the solution, they have given a present value of annuity factor for 8 years 15%, present value of received after 8 years, which is 8th year PV factor also they have given. If they have given, then we should use this only. In here they have given 4 decimals, so we should also follow 4 decimals. Going next, the first will be So here the approach is simple. First we are finding out the equivalent cost of the new machinery, which is coming up to 28,600 here, since the initial investment is 90,000, and 10,000 maintenance multiplied by the annuity factor less the salvage value which we are getting at the end of 8th year. Then we are getting an annual cost of 28,600. In this case, if you see, the initial investment is a cash outflow, and even the in between cash flows are cash outflows only. So we should add it up to the initial investment, and then salvage value is a cash inflow, so which we are reducing it from the above calculated total. Then we are getting an amount of 128,335. Since it is for 8 years, 8 year present annuity factor, we are dividing it up to arrive at this 28,600. Now this 28,600 is at the beginning we are calculating, right? So going further, we will be discounting this equivalent annuity cost if we are deciding to replace at the end of 2nd year or 3rd year or 4th year. Okay, taking up next the replacement decision. If we are replacing immediately, then our cash flow will be 28,600, which as calculated above, then 40,000, which is the salvage value of the existing machinery. So we are getting a positive PV of 11,400. If we are replacing at the end of first year, then the existing equivalent annual cash flow of 28,000 for the new machinery 28,600, and multiplied by first year discounting, then we will have the existing machineries maintenance of 10,000 for that year, then 25,000 will be the salvage value. Here 11,832 is the PV. Now going for 2 years, 28,600 for the new machinery, then first year 10,000, second year 20,000, first year 10,000, second year 20,000, then second year's salvage value of 15,000 has to be considered. Now going we will get a 34,102 equivalent annual cost, PV. Now replacement in case of 3 years. So first year first year 10,000 maintenance, second year 20,000 maintenance. Since we are replacing at the third year new cost PV 28,600 negative, then third year maintenance, then third year salvage value, we will arrive at a 55,799 as PV. Then in case of 4 years it is 82,799. Now if we carefully analyze, the PV is the company should replace the old machinery immediately, because the PV of cost of replacing the old machinery with the new machine is least. So if we check our PVs, in the first case only we are getting a positive PV. It's not just about positive, because we have to see whichever is the least factor to compare. In the given problem, since we have already taken equalized annual cost of the new machinery and then used it in our replacement decision, we don't need to again do equivalent annual cost. If we are not considering the equivalent annual cost, and if we are taking these cash flows like initial investment of 90,000, then PV of the new machinery and PV of the salvage value in the respective years, then we should divide it by the annual factor to arrive at equivalent annual cost. Then only we can compare each years. But since we have already considered EXC, like equivalent annual cost of the new machinery, and then using it as a cash flow for replacement decision, we don't need to again divide it by equivalent annuity factor to arrive at the equivalent annual cost. So in this case, whatever cash flows we are getting, that will be the final. And as we can see, if we replace immediately, we are getting a positive NPV. It's not just positive. If it is least, whichever is least, then we have to go ahead with the least one. And ICAI is given an alternative solution wherein it's the same. The second approach is nothing but, since the 28,600 is already in an equivalent annual cost, which is divided by the annuity factor, if we are going further, then we should bring it to the present terms, because let's say in the first case, this 28,600 is adjusted for 8 years. So I am bringing it to 4 years term. So 4 years annuity factor, if we take 2.855, then if I multiply with 28,600, then I will get the value at the end of 4th year. That 4th year value I can compare it with the immediate decision, which I am getting a PV of 41,652. Then going next, replace after 1 year, I will take only 2 to 4 years as the base. Then going further, only 3rd and 4th year as the base, and after 3 years only 4th year I will take as the base, and after 4 year, whatever is the 4th year, I will not consider that only, since 4 years has exhausted.